So let me extend my welcome to everybody. Thank you for taking the time to join us today. And most of all, I want to extend a debt of gratitude to Neil for taking the time to put together a really very insightful presentation for the TIACA membership. As for those of you that, I'm sure everybody knows Neil by now, but he's the Managing Director of Clive Data Services, one of our great members. And again, as I say, appreciate the effort that he puts in this presentation. We do like to keep it as interactive as possible, so we encourage you, if you have questions, to please use the Q&A or the chat function if you have a question. We'll try and deal with the questions at the end of the presentation so that the material can go through in a sort of orderly process. And we'll try and get through as many as we possibly can before the end of the session. I would ask people to bear in mind as well that the question can't be anything of a sensitive nature, considering there could be competitors on this call. So please keep your questions to more of a generic situation with regards to the data that's presented, rather than perhaps looking at specific market conditions and pricing strategies, etc., that people may be engaged in. With that, having said that, I happily now hand over to Neil, and thank you once again, Neil, over to you.
Thank you, Glenn, for the kind introduction, and a good morning or afternoon, evening, depending where you are. I hope you're all safe. In the next 20 to 25 minutes, I'd like to give you a brief update on some of our latest analysis on the global air cargo world. So let's first have a look at May. And looking at the May numbers and what we've done, and you probably recognize the chart type that we also used during the session we had in February for the TIACA members. So what we show is the chargeable weight, capacity, and dynamic load factor trends versus May versus 2019, as well as 2020. And let's start with the 2019, because that's a more relevant comparison with regards to the current state of the industry. There we see at first glance that the numbers are less positive than they were in March and April of this year, and even more so in February. The last couple of months, we saw a more or less at par comparison with 2019, but in May, we've seen a -4% decline in the chargeable weight. We've seen the gap between the available capacity in the market currently versus 2019 increase. In March, it was -14, April was -18, now it's -21, so the gap is enlarging. And we also see the dynamic load factor is still substantially higher, 7 percentage points versus 2019. But here is the disclaimer. It's easier to quantify the stats in May than it is to qualify it, to assess them, to put them into perspective. Because May 2021 was quite different to May 2019. We had extended holidays in China, Russia. We had also the festivities around the Ramadan, which took place in May this year, which did not take place in May in 2019. So the extended holidays and the presence of her holidays that were not there 2 years ago will have surely affected these numbers. To what extent is difficult to grasp. As I would say the jury is still out. We'll know more once we review the June stats. So we shouldn't be judging the book on its cover whether we've seen now a downward trend relative to the previous couple of months, or whether it's just a hiccup because of these holidays. If we look at 2020, and we see the blue bars, I think the initial we had last month, we were about 170% more chargeable weight, because we were really at the peak of the crisis COVID-wise, as well as on the capacity side. But now we see that because the airlines started flying more in May than they did in April last year, we see that they're now around 40% increase in chargeable weight and capacity relative to last year, and that the high load factors that we see now are comparable to what we saw in 2020, May. And so overall, a bit of a question mark on how to interpret May. What is still undeniable is that there is a lot of, there's still a lot of stress on the air cargo global capacity. And we see the global load factor was at 69% last week. So we have data up until June 6. And we drew the line to give you a clearer perspective on how high that is relative to earlier peak seasons. If we look at the peak season, November, December 2019, or in 18, that is still well up below the current May load factors. And May is not typically known for being a peak season in air cargo. But we also see that the load factor has been declining. In the global load factor in March was 73%. It turned to 71% on average in April, and now we're at 69% in May. So there is a bit of a downward trend, but overall flights are still very full. As you might recall from the previous session, we should be careful also in judging that around 70% mark, because on the global perspective, the dynamic load factor can practically not reach higher, much more than 80%, because of the trade imbalances that exist around the world. So if a maximum is 80% and we're now at 70%, it means that flights are still extremely full, on the front haul legs, or completely full on the front haul, and pretty full on the back haul. So still a lot of pressure on the global system. If we would zoom in more on a regional level with regards to the load factor, and we see a bit of a change in the year-over-year comparison. And load factors are still high, across the globe. But when I showed this chart 3 months ago, all the year-over-year changes were dark green, meaning that the load factor was more than 5 percentage points higher on these lanes. And now we see a different perspective. Some of them are light red, meaning that the load factor is slightly less than it was in 2020. But that is a result, not so much of what's happening today, but more of what happened a year ago, where the few flights that were being operated, they were just chock-a-block full, and many of them also with PPE materials. But you do see that already last year in May, the load factors were at the level that we are currently experiencing. But the recovery has not been equal everywhere. So let's look at a few important lanes. This is China to Europe. We have 3 lines. So the dark blue is more the benchmark or the reference. That is the 2019 volumes. And what we did is we set the volumes in week 4 of 2019 at 100. And at an index level. And then the light gray is what happened in 2020, where we see the big fall in volumes initially because of Chinese New Year, but then for the prolonged closure of the factories. Then we saw the steep peak of PPE traffic, which then faded away. And then looking at 2020, we discussed during the first session this year about the less pronounced fall in volumes around Chinese New Year. It was then that also the Chinese government and companies invited factories to stay open, to people to work, to avoid travel. But as of late, and then it followed more or less the pattern of 2019, but in the last couple of weeks, we see that the gap between 2021 and 19 is closing. And actually the last week, it was more or less the same as we saw in 2019. Policy of the Chinese government, I've read it is different. It prolonged the holiday in May to stimulate domestic travel, people spending, and maybe that has affected the trade. Maybe factories will close for a longer period of time. So it's again too early to tell whether we see a change in trend compared to the previous week, or it's a blip. But at least it shows that for the last couple of weeks, the difference, the improved volumes relative to 2019 have faded. But still a positive signal when we look at the last couple of months. Less so when we look at Africa, the continent. On the left-hand side, same idea. So the dark blue is 2019, the light gray is 2020, and the orange are the 2021 volumes, where we indexed it again, the volumes of week number 4 in 2019 as 100. And here we see that Africa so far has not been able to recover from the COVID crisis. And the continent is really trailing the global average. And I think a fair hypothesis about that is that the lack of air freight services into the African market. There's still, well, I think, sorry for stealing your thunder maybe, Glyn, but I think you mentioned earlier this morning that international passenger travel is down minus 80 or 90%. And with airlines needing high revenues to operate those freighter aircraft, they choose to fly to other destinations than mainly in Africa because of the yield they could achieve, and therefore also the opportunity to recover seems to be slim. Hopefully, when more and more people have their vaccinations and markets open up again, that the return to belly capacity will also help the African air freight market. But so far, with a small exception, it's not been able to reach the 2019 volumes so far. Then if we move to the Atlantic, we would like to emphasize here the difference between the front haul and the back haul lane. So what we show here is again, we indexed it. Now on week number 4, 2020, we indexed the capacity. So just before COVID hit, and those are the blue bars. So they indicate the capacity in cubic meters across the Atlantic. On the left-hand side, we see it westbound, and on the right-hand side, we see it eastbound. And the orange line indicates to the right-hand side the load factor. And what we see that because of the COVID crisis, this market predominantly served by belly aircraft, saw a major drop in capacity. As a result of that, load factor jumped. And what we see on the left-hand side, that the load factor westbound has been hovering around the 80-85% more or less continuously. While on the left-hand side, with the same amount drop in capacity and more or less the same increase in percentage points, we see that the eastbound load factor hovers between 70 and 75%. And if we look at the rates, we would see that the westbound rates triple in certain markets, while on the eastbound, so from North America to Europe, maybe 1.5. So the increase was double the amount Europe to North America than it was from North America to Europe. And that is, and I think we also touched upon that in the previous sentence. We think that is a large part of that is because the 80% load factor is more or less a tipping point between whether it's a seller's market or a buyer's market. And if we look at North America to Europe, that didn't cross that threshold. It stayed well below the 80% mark, and therefore, even though it became busier and capacity was less available than in pre-COVID times, it wasn't as cramped. It was still there were still options available for many airline clients to choose what they would like, how they would like their cargo to be moved. So it was the buyers of air freight capacity had still quite a bit of negotiation power. On the other side, when it went above the 80 and well above the 80, even to 85, and then instead of being a seller's market, instead of being a buyer's market, which it was pre-COVID, the westbound really became a seller's market because there was so much demand relative to the available capacity. And therefore we see that rates increased far more, well, double the amount that we saw on the eastbound traffic. And if we look at that in more detail, we see more things happening. So this is an overview I know it's a busy chart, but please allow me to explain a little bit. So what we're looking at here is a rate analysis from Western Europe to selected US airports. So we're looking at the front haul, at the busier lane from Europe to the United States. So on the top, you can see the destination airports, Chicago, New York area, Atlanta, LA, and the Boston area. And then we have a couple of key metrics. So what did the spot rate do? And the spot rate, the definition that we applied here was rates that were valid for less than a month. So that was their horizon. Then the seasonal rate, those are rates that are valid for longer than a month. Then we have the spot share. So how much of the total chargeable weight that was sold on that market had a spot rate. And finally, the dynamic load factor. So what is interesting to see, and hopefully should be now not surprised, if we start with the dynamic load factor, we can see that all of these markets jumped from a buyer's market into a seller's market, and they all crossed that barrier of around 80%. And there where we see the strongest increase in New York and Boston, that's also where we see the largest increase in load factor. In New York, up 23 percentage points. And I don't know how many flights there were pre-COVID from Western Europe into New York, but there must be much less of them at the moment. So that pressure on capacity is reflected on a much higher load factor. What we also see, because of that jump in load factor, the spot rates, they've also increased substantially more than we look at the seasonal rates. If we look at Atlanta or LA, more than 3 times the actual rate into Los Angeles, while the seasonal rates, which have a longer horizon and therefore are less prone to heating up, although there are a few exceptions there, we see they did not increase as much. We also see a structural change in how the wheeling and dealing takes place. Because if we look pre-COVID, you could see that 18% of the chargeable weight from Western Europe to New York was on a longer term rate. And only 18% of the volumes had a spot rate on it. So you can imagine the forwarders had the rates with the airlines for the winter or the summer season, and there wasn't too much wheeling and dealing taking place. Currently, and we look at the last 4 weeks, we see that 46% of the chargeable weight from Western Europe into New York had a spot price on it. So there's a lot more wheeling and dealing going on, whether it's for a specific shipment or whether prices are just set for a month. But there's a lot more a short-term focus. Same into Boston, it was 17%, now roughly half the shipments. And that also indicates how erratic the market still is and how little appetite there is between both these stakeholders, airlines and forwarders, to set longer-term deals, because there's just a very uncertain outlook in what the market does, and apparently people feel better by moving from one short-term deal to the next. So this gives you hopefully a comprehensive overview of how the dynamic load factor, as a result of the reduction in capacity, started to impact the spot rates. And as a result of that, we've seen a change in the structure of the market, and that more and more airline/forwarder deals were on a short-term basis. And on that note, Glyn, I'm happy to take any questions from the audience or from your side.
Excellent. Thank you, Neil. Excellent presentation. And this slide, let's keep this on screen, because I think that is so, as you say, such a strong indication and such a clear correlation between the dynamic load factor, the shift balance between a buyer's market, a seller's market, and the consequential impact that it can have on both the rate structure and, of course, we know in terms of the rates themselves. We do have a question here from Jason that says, do you think the potential permanent reduction of business travel segment for airline can be offset by cargo revenues in the future, perhaps by continued growth in e-commerce? Neil, do you want to take a stab at that, or would you like me to kind of put my tuppence halfpenny in here?
Yeah, I don't think I'm wise enough and knowledgeable enough to answer that in a meaningful way.
No, you see, you're wise enough to know that you're not wise enough on those topics. I'm not wise enough to know I'm not wise enough. So, you know, it's a good question, Jason. I think it's one that everybody is certainly looking at in terms of how do we get back to the pre-COVID levels of business. And as Neil had said in his presentation, the IATA numbers that came out shows that the international passenger business is still about 88, 89% below that what it was in 2019. Even though domestic has recovered strongly, much of that strong domestic traffic, passenger-wise, is through frustrated international travelers. So it's not the traditional domestic, it's traditional domestic plus new domestic of people who can't go international. I think you do raise a wise point, though, about the long-term future of short-haul business travel in particular. I think the technology that we have today is far superior than the technology we had 2 years ago to conduct face-to-face via technology discussions and meetings. You know, we used to use Skype 2 to 3 years ago, and it was pretty much disastrous. You couldn't speak at the same time, you get pixelation, connectivity was bad, and yet now it's commonplace. So I think you're absolutely right, there will be an impact. I think the other factor that really comes into real consideration is, you know, if you look at the various analysis of when that passenger business will resume, some optimistically think it'll be 2023, some say 2024, others say a bit longer. But the level of international traffic that we experienced as an industry in 2019 effectively had built up over the previous 10 years. It was from the global financial crisis to 2019 was almost non-stop linear growth, 4 to 5% per year for the passenger side. The fact that it's going to recover from where it is now up to the level that took 10 years to steadily build up that in a short 2 to 3 year time frame, I just can't see the dynamics of that happening. So to the point of your question is, cargo will absolutely, in our view, or in my view, maintain that strong, perhaps not 35% of industry revenues where it was last year, but certainly it will be a considerable factor when airlines start resuming international passenger services. Because of course, the minute they start opening up, and I know there's a meeting today between President Biden and Prime Minister Boris Johnson about trying to get US, UK, North Atlantic passenger routes reopen. But of course, the day you start opening them, you haven't had 9 months forward selling. You haven't had 80, 90% guaranteed business or 70, 80% guaranteed business. So they will start with low load factors, and therefore cargo becomes extremely important.
May I add a comment
Sure.
to that, Lynn? Because the conversation will take place to open up the market again. But there are already a lot of planes flying across from the UK or from Europe into the US with very few passengers on them. So what I would expect to see happening, and I think I also alluded on that at the previous session. So the first thing that the airlines will do is they will try to fill up the flights that are currently flying. They're not going to add a lot of frequencies, I think, because they need the cargo to make that plane viable, even on the short term. So with those belly flights, when more passengers starts filling up the flight, there'll be less room for cargo because they'll have their bags. So it's not unthinkable that we will see, once the passenger comes back, that we'll see a fall in air cargo capacity in the short term, until they start expanding, let's say, upgauging and adding frequency. But
I totally agree. I totally agree. In fact, they will be competing with themselves. And as you say, you've got a passenger, if you've got a passenger 777 now going transatlantic with no passengers on board, you can get 55 tons. And you saw from your earlier charts, the market dynamics are such that on North Atlantic, or transatlantic, you should say, the business is doing incredibly well. But the minute the airlines, as you say, start putting 1 or 2 passengers on some of those flights, or looking at the passenger flights that exist already and start putting more cargo on, you then actually, or they will be competing with already exists. So it's going to be an interesting dynamic to watch. I think from a global perspective, the situation is still unclear as to what the conditions are for reopening of the travel corridors, as it were, working with ICAO on public health corridors. Vaccinations are not sufficient to reopen the travel routes. You still need that regime of testing, and countries still have that regime of quarantine because they're concerned about further strain. So that is certainly putting further pressure on that resumption of passenger business. But I think it's a great question. Neil, we have another question that's come from David. Is asking about the dynamic load factor. When you talk about 80%, saying that that's the point you see it pivoting between the buyer and seller markets. Could you just perhaps clarify what you mean by there? Because you talk about the max around 80%.
Yeah, so we bumped into that number. It's not that we did some advanced math and said, okay, it must be 80%. We're looking at many different routes and comparing it to what the rates did. We saw that an increase from in the 70s up to the 80s saw a higher increase in rates than if the load factor would go from 70 to 75%. So it's more we see it happen in practice. And why is that the 80%? To oversimplify things, if it's below 80%, it will be the forwarder in some form or shape that will ask the airline, do you want my business? And if I don't get it at the right price, I'll give it to somebody else. If it's above the 80%, it will be the airline that will say, do you want my capacity? And if you don't want my capacity at that price, I'll give it to somebody else. So oversimplified, black and white. But that's where we see the change in negotiation power, and potentially the smell of fear on one side. Will I be able to fill my aircraft, or will I be able to move my goods? Is where we see an exponential growth. But we would also expect it the other way. If it goes from plus 80 to minus 80, we would also expect an acceleration in the decline of the rates, because then the table turns again and it will become the forwarder who would have one would expect a more powerful negotiation position, because it simply has just more options available.
Okay, excellent. That's a good explanation. And I think another factor, of course, as well is what's happening on the maritime side. We're still seeing record high levels in terms of rates for TEUs, record high levels of congestion, and also even just once the ships have actually been offloaded, is they're still having hinterland challenges in some ports. So of course it's a very dynamic, and it's a very, shall we say, stressed international logistics environment. And I saw some figures that came out earlier this afternoon from the US consumer. The consumer prices, inflation is up in the US because the consumers, many of them with the stimulus checks in pockets, many of them have not been able to spend on holidays and another factor, and the employment situation is improving. There's a lot of consumer behavior going on there. Retail sales I think we're growing at 13% for the first part of the year, which is double the estimate that they expected, and almost at record high levels of growth in retail sales. not just all online, some in bricks and mortar. So I think that scenario that you paint going forward, as you say, is we need to look at the numbers to see what happens in June.
Maybe
so
interesting example, which I heard actually in between our morning and this session, Glenn, from an apparel company, to show how much stress that company had logistically when the rates went through the roof, air freight wise. So they had a normal budget. They spent actually less on air freight last year than they did in 2019. You go, how did they do that? Well, what they simply did is all their, let's say, their business units, for every single purchase order that had to go air freight, there was nearly a board approval required.
Right.
So they install a mechanism that only in extreme situations was air freight allowed. Otherwise, it would have to go ocean. Because of the raise in rates. So you can imagine that put a tremendous strain on that organization.
It did, and I think, yeah. And overall supply chain costs, because the maritime costs are also running at 200 to 300% higher than they were in pre-COVID times. So, the overall cost of logistics is obviously translating it through into the price in store. But inventory levels are also still quite low. So reading some other reports in terms of restocking and stock levels, so that also bodes well for air cargo going forward. So I think we're in the middle of, it's an interesting time. And I think as your comparisons earlier on had indicated that, this time last year, the industry was still only expecting this to be wrapped up by the end of summer. So they hadn't really stepped up all of these passenger operations for cargo only. It was starting to come in May and really sort of accelerated as we move through the summer and into the autumn. So it'll be interesting to see how those comparisons move forward in the next couple of months. Excellent. Let me do a final check with anybody out there. If they have a question, please use the chat or the Q&A. And whilst people are thinking, Neil, could we just go to the last slide so I could just do a...
Yeah.
Please. Just a quick reminder to everybody of what we've got coming up from the TIACA side. We have some ICAO partnership that we do for a safe supply chain course that we do virtually. Now we've got a few running. One is next week. If somebody's that eager to go, then it's 1 week after. You see, we're trying to put these at different time zones so that people can slot in where they see fit. If you need information more about that, please just drop us a note at TIACA. And a reminder to everybody that we have our Executive Summit coming up in September 21 to 24, which we're doing in organization with Messi München Group. So it'll be a fantastic 2+2 event because we have not just the 2 days Executive Summit, but we then have a 2 days very fascinating insight or journey into innovation, where we'll be doing a tour through some of the leading Silicon Valley tech companies, etc. And it should be a fascinating opportunity for industry to reconnect as well. So with that, I will do one final check if there's any other questions. I see nothing else has come through. So Neil, thank you once again for putting all this information together. It's absolutely fascinating. I could just study some of those charts just to try and picture in my mind, because it's a certainly very clear way of illustrating what it means